What? Negative 9.26% in 2018? Can we invest in this? Absolutely, man. Hey guys, this is Dave on YouTube, with Military Money Mastery. Today we're going to be going over this fund. Super exciting, super important fund to be going over. As you can tell, I'm really excited about it. This is a fund that I have a lot of passion with, that I invest in heavily in certain times, and we're going to go over some of that stuff, and we're going to explain why it's a really good fund to be investing in. As you can tell, it's done really good growth, 13.67 over the last 10 years. That's really, really good, because that's including this, right? That's including the negative 9.26%. So that's awesome. You can see since May 2001, it's gained an annualized growth of 8.2%, which is very solid. It's very, very good, because we've had some down markets. That's including the 2008 bust, which they lost like 50-something%. So that's huge. So in today's lesson, we're going to be going over what the S fund is. Obviously I wrote it down here, but it's a Dow Jones Total Stock Market Index fund. So it's got a very, very good mixture of all the small to medium-sized businesses, US-based small to medium-sized businesses. So it's a really cool fund to get into. It's really great for growth. We're going to explain what the benefits are. Like as you can tell, I'm really excited about the growth, because there's tons of really cool companies in there. There's companies in there that I personally love. Tesla is like one of them. Twitter, tons of people use Twitter. That's in there too. So we're going to go over that. And then we're going to talk about the risks. So obviously with high rewards come high risk in stocks, and it's kind of just like one of those things, unfortunately, we have to deal with. But because of the risks, we can make even more money. And we're going to explain how we can do that in the future.
All right, so let's go over the S fund. So S fund is, it's in the Dow Jones Total Stock Market, so TSM, DJTSM if you're looking for the anagram. It means it's a market fund comprised of small to medium-sized U.S.-based companies that are not listed in the Standard & Poor's 500. There's a lot of cool companies in there. I know Tesla's in there, and the whole fund comprises about 3,300 different stocks. So it's a pretty decent sized investment fund. It's not too bad as far as the size. And the best thing to know about the size of the fund is that the bigger the fund, the less volatility there is as far as like day-to-day prices. So you won't have like one company absolutely tanks, which would drive the entire fund down. So that's kind of a cool thing. So let's talk about some of the benefits of the S fund. So because the S fund is comprised of small and medium-sized companies, it has the potential for a super high growth rate. I know that the S fund typically has, when it's growing, has more growth than the C fund. And that's really, really cool. If you get into the S fund in an up market, you're going to be making tons of money. I know the S fund, I think the S fund beat the C fund last year as far as percentage growth. So that's really, really cool. So because of the smaller size companies in this fund, it also has added benefit of better long-term growth too. Well, maybe not better than the C fund, but it has really good long-term growth in general. As typically small to medium-sized companies outpace larger companies as far as growth percentage goes, because you have to grow from a small or medium company into a big company, right? So Tesla, for one example, I'm pretty sure they're going to be a big company in the future. So getting into them now means that later on, when they do become into that Standard & Poor's 500, when they become a large company, they'll be worth a lot more. So it's a very good market to be in the U.S. economy as far as growth goes. And for all of 2017 and most of 2018, I think it was the best performing fund. I know the I fund was pretty okay, but the I fund is so much more volatile than S fund. And personally, I'd rather invest in like U.S. based economies. So we can go over some of the risks, and I'll show you a graph in one of the future slides. But there are some risks. Like I said, the S fund typically has the highest potential for growth as far as the funds go. It also comes with the highest potential for loss. I know 2008, I think it was the biggest loser, and 2000 or 2001 when you had the .com bust. That it was probably one of the larger losers, even though, well, I guess it wasn't really around then, but if it was, it would have been one of the biggest losers. But when you look at, highs and lows, the S fund typically has the highest highs and typically has the highest lows. So that's something to consider. So because this market follows smaller companies, it has a higher possibilities of the companies going bankrupt or failing. Something you have to watch out for. I mean, it's not really likely that Apple tomorrow is going to declare bankruptcy, or Microsoft tomorrow is going to declare bankruptcy, but some of these smaller to medium-sized companies, that could happen, and that's something that you can lose money on, but it's still not very likely. But like I said, it can happen. So it's what's known as risk. Stocks, funds, whatever, they have high risks, and that's just if the higher the risk, the higher the reward, but also the higher risk, the higher the loss. So that's something you have to kind of accept if you're going into this fund. So with a high risk fund, it's hard to invest for the long term because it's subject to some of the losses. So in 2008, like I was mentioning earlier, the S fund lost 57.4%, which is huge. That's absolutely phenomenally huge, and that's huge not in a good way. So if you're pretty good about looking at markets and understanding, basic economics of the country, you can tell when a country's doing good, or you can tell when the country's not doing good. As financially, you can, hopefully get out of it before you hit that large dip. And that's something that I kind of did last year. I stumbled into it on accident. I say accident, but I was kind of looking at it at the same time. But I got out of the CNS fund just before October hit, when the funds were tanking. Got pretty lucky, but some people they lost a lot of money. So let's go over why you should invest in the S fund. So the most important part of determining how much you want to invest in this fund, like I say with every fund, do you want to put in 100%? Do you want to put in 50%? Do you want to put in 25%? It really depends on what your risk is and how much you want to make, or how much you want, or how much an acceptable loss would be is one of the really big points that you should be looking into. So it's very important to diversify your investments. I mean, I'm sure you've heard tons of experts saying that. If you're looking for short-term growth, you don't necessarily have to, but if you're looking for long-term growth, diversification is really, really good. It's also important, that if you're going for long-term, don't dump like 95% to the S fund, because you're it's too much weight into one fund. But if you're, short-term and you're kind of looking at it and kind of, month trading, I wouldn't say day trading because that's not very good, but if you're like month trading or, kind of following the markets, you can make a pretty good amount of money by, putting higher weights into some of these more volatile stocks. So when you're young enough to recover, it's also extremely lucrative to be more risky. So to have more money in the S fund, because you want to grow. So it's actually really, really beneficial. So if you're, first termer, you're like, hey, I joined the military, I was 18 and I don't know what I'm doing as far as like long term, but I'm 18 and I'm investing. What's the best thing to go into? I would say probably the S fund for a good majority of your early 20s, because you're going to have the opportunity to make tons of money. If you're, hey, I'm 55 and I'm about to withdraw from the TSP at 59.5, should I be putting in an S fund? Probably not. But it depends on, are you trying to make a bunch of money before you get out? Is the market good? Is the market bad? If the market's good, cool. Put some money in there. If the market's bad, then no. Also, how much money are you willing to lose? Would you gamble your entire retirement on a good market? I don't know. That's up to you. So for long-term investors, a smart path to invest in stock markets, because stock markets typically outpace everything else in the long run as far as investments go. So that's what we're here for. We're not here for, hey, I need to make $1,000 by tomorrow. We're here for, hey, I need to make $1 million by the time I'm 59.5. I know that sounds like a lot, but it's really not. I promise you, everybody can do it. super easy. It's not to say that you can't make profit in other markets, other means, like of course there's real estate investing, there's like opening your own business, you can get bonds or play the other markets, and you can make money that way, but stocks over the long term have shown to outpace many of the other markets. So it's really good, and it's really what you want your retirement to be: consistent growth. So we're going to go over a couple of slides here that I got. I know slideshow presentations kind of suck, but I just wanted to kind of show you guys a little bit about the S fund. So here, obviously, it's a Dow Jones market. This is what traders and people. You're like, oh, Wall Street investors. This is what they look like. No, dude, I'm an investor and I don't work there. But it's important to know what fund it is, because then you know how to watch the market. So here's that PDF for the S fund, just like we had for the C fund. Key features, opportunity to earn potential high investment return over long term. You can see a bunch of the companies down here. You got Tesla, Las Vegas Sands Corporation, a bunch of resorts in Vegas, which if you haven't been to Vegas lately, it's really booming. It's been doing really, really well. You got Dell over here, which is a military contractor. They do pretty well. T-Mobile, if you have T-Mobile, hey, you're investing back in your company. Twitter. I'm sure everybody's heard of Twitter. It's one of those, are they up and coming? Yeah, kind of. Are they falling off? Yeah, kind of. They've been doing pretty good. But you can look at growth of inception since 2001. And you can also see right here, can't really zoom in too much, but this is 2008. So you can see how it was like a negative return, and it's hugely negative. But look what happens after the negative return. Up, up, get a little down. Up, up, still up. Kind of down. Up, up. So right now, if you looked at, because this is from 2017, if you looked at the 2018 market, is probably down a little bit. It started off the year like cooking, but towards the end it dropped off pretty hard. But you never know. Like we could potentially have a really good year this year, and I'm optimistic about it, like usual. So here's the completion TSM index. It shows you everything that it's in. You got financials, IT stuff, energy, materials. So it's pretty diverse market. Like I said, so it's small to medium companies, so it's going to be super diverse. It's going to have just a little bit of everything. It's kind of a melting pot. They got more stuff you can read over here if you're really, really interested in learning about it. It's a pretty cool investment fund. I actually dip in and out of it quite a bit because it's super lucrative if you're trying to increase your retirement growth. So let's go over here. This is the Thrift Savings Plan website if you're trying to learn about it. So you go over to S Fund here, investments, go over to the S Fund. It's going to bring you to this page, and then I'm going to clicked on performance here because I think that's more important. So key features. Key features, basically what I just told you, but they have that PDF, just like in the C Fund video. If you're not sure on how to find that PDF, go to the C Fund video, watch that one. I would highly suggest watching that one anyway, but go back, watch that one, and find out where to grab the PDF. It's down here. So we're going to go to performance, and this is just showing how the stock's been doing. This one was actually updated in 2018, which was nice. So it doesn't say. Oh, actually it does say right here. So December 2018. So you see it start in January 2018. It's doing good. Drop, a little bump, drop. Big drop, so like 11%. Or close to. So it's a good and bad thing, right? So Warren Buffett really stresses that you need to buy in down markets because you can get stuff so much cheaper. The share price for the S fund is extremely low right now. So if you start dumping money in there for the long run, you're going to have a lot more. You can buy a lot more positions in the fund, which is really, really good for the long run. So, hey, I know the fund's down, we lost 11%, but dump more money into it, and over the long run, you're going to make a killing back, I promise. But you can look at, it says the 9.5 negative 9.5% Dow Jones US, and so the S fund, obviously, it's you know, kind of mimicking it, but you can see it's like a negative 9%, which, like I said, that just brings the prices down so you can get more shares into it. But you have you look over here, over the last 10 years, it's actually gained 13.67%, which is phenomenal. That's like so good. If you can average 13%, like that's really, really good, I promise. You can see the inception growth, which, you know, it's okay. And then you can see entry returns. Like, look how high these are. Like, that's tons of money. If you have, you know, $100,000 or more in the TSP and you're earning, you know, like close to 40% growth, like, you're killing it. You know, that's like fantastic. So something to keep in mind. We can go to the next slide. So this is just, you know, a little bit of history on the Dow Jones. So you look here, so this is inception since 1970, right? So pretty low down here, and you know, you have a big drop in the mid 70s, which a lot of investors like lost out hard on. And then look at this growth. Okay, so here's, you know, the .com bust, and then here's the 2008 bust, and then we're going up. This is 2017. So this is the right here. This is the end of 2018, and you can see, okay, September, you know, doing good, boom. So a huge drop, which means if you were invested solely in the S fund, your investment fund's value is significantly lower. However, if you weren't in the S fund and you started buying right here, or you're buying right now, you have access to way more funds than you did right then. So that's just why it's super important to be watching these funds. It's beyond lucrative too. And I mean, I can tell you too, but like, you really need to just go and just keep an eye on it. It takes me 2 minutes a day, and that's it. You know, look at it. It's like, oh, okay, you know, what are the markets doing today? Can I invest? Can I, you know, take a risk today? Or how's the market's been doing the last couple days? Has it been doing good? Okay, you know, maybe I'll invest some. But it's super important to watch these. Like, you're talking about your retirement. You're talking about the money that you want to sustain yourself on for the rest of your life. So just keep an eye on this stuff. It's super easy, but yeah, like, right, if you invest in the S fund right now and the S fund goes back up, you're gonna be absolutely killing it. But anyway, so I've been Dave from Military Money Mastery. Thank you guys so much for tuning in. Next week we'll probably go over the I fund. It's also a very lucrative fund. But yeah, so if you could, you know, please drop a like and subscribe, and just let everybody know about the channel. It helps out a ton, and I'll catch you guys in the next video.